Are we experiencing a bull trap in the market, or do you think it's a new bull market? The market is very frothy right now, but is this nothing more than a false alarm before a potential crash? Well, that's not how everybody else sees it. 55% of my followers said we're experiencing a bull trap. However, and this is what surprised me, 45% said this is a brand new bull market. So first off, a bull trap is when investors think that stocks are on the rise and they buy only for stocks to fall again. It's usually during, obviously, a bear market run. We feel, you've seen this chart before, guys. We've talked about this many times. Where do we stand in the market? We've seen this in other videos, and this would be the bull trap. Like, oh, everything's great. We're back to a new bull market. Let's keep going before a big fall. Essentially, it's a false bull market within a bear market decline. So if you're new here, welcome. I'm your Uncle Paul, and I've been investing in stocks, ETFs, and real estate for well over 20 years. If you've seen our content before, though, you know that I do not believe we are experiencing a new bull market, contrary to the 45% of my Twitter followers who think otherwise. However, we really haven't seen the bear market that I've been anticipating for, honestly, quite a few years. The closest thing to a bear market in recent years was that COVID crash that lasted basically only 30 days, but the market fell a hard and fast 40%. If you go look at me back in the day, I was so excited back then. Deals were coming, deals were flying. So let's get to the bottom of this. In this video, I'm going to go over 4 key reasons why a bear market is on the horizon, and the current euphoric state of the market could prove nothing more than a bull trap. So first reason why I believe we're experiencing a bull trap. Interest rates have skyrocketed. Mo, what the hell have we been saying? So before all this, you know, the common comment in the market was interest rates are zero. That way you get 2% dividend yield, you get 1.5%. And everybody was so afraid of rising rates. Yeah. That was back in March of 22.
Right.
Do you remember what the S&P was back then?
I do not, but I remember it was getting hit pretty hard in that time.
So the S&P started, right before rates started to go up, the S&P was at 4,500.
Okay.
Rates are at 0.
Okay.
Now rates are at 5.25. What's the S&P at today?
Here we are. So let's
45.50.
This was your October fall right in here, and here we are back to nearly all-time highs.
Yep, but it's higher than when the rates started to go up.
Yeah.
This clearly does not add up because everybody was so afraid, and it makes sense, by the way. It makes sense. If you can get risk-free 5.5% return on your 90-day treasuries, what return do you need to make on stocks in order to justify it?
You need to really outperform.
Yeah, this happened. This is hypothetical. Let's go to extreme. Let's say a 90-day rate becomes 20%. Are you okay making 10% in stocks still?
No chance.
Exactly. The risk-free rate is 20%. Why would you ever accept 10%?
Right.
So it does make sense, as Warren Buffett has said many, many times. Interest rates work as a lifter or a drag down on valuations. The higher the interest rates, the lower the valuations need to be because you need to get a better return on your money because you can get that risk-free rate from the government at a much higher rate. Makes perfect sense, okay? The second thing that matters to me, current valuations. Now, guys, there are 2 main metrics I look at. One is the stock market GDP ratio, which I know a lot of people will argue me about. And the second one is the 10-year cyclically adjusted PE ratio. Now, the stock market GDP is very simple. You take the entire GDP and compare it to some sort of stock market valuation. I take the S&P 500, you can take the Wilshire, you can take any broad-based market. The point is you're looking for discrepancies from the past. The 10-year PE ratio is very simple. You take the last 10 years of earnings on the S&P, you bring it to today's dollars with inflation, and you divide the S&P price by that. Now, here's where it gets interesting. Let me show you some charts, Mo. Here's the stock market GDP ratio going back to 1929 compared to the S&P. Here we are.
Pretty high up there.
Here was the dot-com bubble.
Higher than the dot-com.
Here was the Great Depression.
We're approaching the Great Depression.
We are in the middle of the Great Depression numbers.
Yeah.
So if I were to ask you, are we in the beginning parts of a bull market based on where we start in valuation or the beginning or in bull trap? What would this indicate?
Bull trap.
Yeah, I would agree with that. Guys.
I mean, unless it's completely different this time.
Exactly. This is where Warren Buffett closed down his shop. You guys realize that Warren Buffett took investor money at this point and said, there are no good deals out there. I'm returning your money. He closed down his partnership, returned all his money. It was only until here or so he started reinvesting. He opened the partnership back up again. This is the dot-com boom. What happened to the dot-com boom? This is the great financial crisis. What happened here? So, do you think this is a new bull market that's going to last decades? We want to believe that. We want to feel like we're going to be richer.
Makes you feel good.
Absolutely. Now, you might sit there and say, Paul, but stock market GDP, the thing I hear a lot from all the haters out there is, you don't get it, Paul. Stock market GDP doesn't matter anymore. Okay, let's just go based on earnings and purely earnings, because earnings don't care where the money's earned. This is the 10-year PE ratio going back to 1871. Great Depression. Warren Buffett shut down his fund. .com. Last 2 years ago, now. Historical average is 17.
We're right around the Great Depression.
This is the historical average right here.
We're almost exactly at the peak of the Great Depression.
Yep. So guys, again, if you understand valuations, you understand where a new bull or bear market might be forming. And I look at this right here and I think to myself, what is more likely? That we're in a new boom that's going to take us to higher levels, or that things are a little, and we combine this with interest rates where they are, it makes it very, very difficult to think, okay, no, we're in a new long-term secular bull market. Mm-hmm. Those things last 15 to 20 years. We've already had this run for 15 years. The 2009 financial crisis, look where it fell to. It fell to about 13 and change. Now it's at 30. What makes more sense here? At some point, valuations need to get worse as fundamentals improve. So it'll probably be a combination of valuations falling, fundamentals getting better. That's what happened significantly back here. Stocks went flat, but valuations got a lot better here. But stocks were even from here to here. Why? Because prices stayed flat with a lot of volatility, ups and downs, but fundamentals got a lot better. So that's probably going to be some sort of combination of what happens here. Where the stock market will bottom, I have no idea. And nobody can possibly guess. What I want you to do, though, is to learn that you can buy at good times, at better times than today, and make a lot of money. At some point, valuations will matter. Third reason why we're on our way to a bear market is that many outside terrible companies are starting to go to zero. Guys, I'm going to pat myself on the back, and I'm going to pat Mo on his back. 2.5 years ago, February of 2021, I encourage you to go back and look at our videos. We were criticizing every company out there. Those companies, Workhorse, Nikola, Tattooed Chef, Peloton, all these companies that everybody said we were so wrong about. Where are they now? 80, 90, 100% down. Crappy companies that didn't have earnings, didn't have profit, and were flimsy and selling at crazy valuations. That's the outside. That's the outside break, just like an iceberg. When an iceberg breaks, it doesn't break on the inside, it breaks on the outside. The weakest parts first. Those are the weakest parts. Now, I couldn't find a deal 2 years ago to buy stocks. Now, I even find major companies like PayPal, T. Rowe Price, Generac, off 70, 80%, but still fundamentally good companies that were just selling for egregious valuations.
Yeah, it's amazing looking at some of these companies. Workhorse, $42 a share back in 2021. Today it's 36 cents.
99% drop.
This is my favorite one, though. Tattooed Chef.
Bankrupt. You can't even look it up.
Sorry. There's nothing. Jeremy
from Financial Education literally argued with us saying we didn't understand. He said, go believe in the company first, then look at the numbers. And we said, no, not that way. Don't get me wrong, guys. We've had stocks that go down. The difference is when our stocks go down, we get excited. And unless our thesis has changed, we still get excited.
Nikola, $94 a share is a high, 97 cents today.
So it's not as bad as Tattooed Chef. I mean, not as bad as Workhorse, because it's only down 98 point some percent, but it's still pretty bad. And guys, this comes on the back end of everyone is an investor these days. When your 14-year-old neighbor, the caddy at the golf course, starts giving you stock picks, which would happen in June of 2021, or when those crypto coins are shooting up in value for God knows why, you've got to take a step back and say, what's going on here? Should this really be happening? Should the pimply neighbor next door be able to tell me why Tesla is a great company? We believe we're in the end phases of this bull market. And unfortunately, part of that has to suck people back in. And that's what's happened the last 8 months, 9 months. Could we be wrong? Absolutely. But I look at the saying, what's more likely? The crypto craze has calmed down a bit. In fact, FTX and Binance and all the other companies are facing some serious charges right now. Not to mention all the high-flying EV stocks, Lucid, Lordstown, Nikola, Rivian, and even NEO have sunk incredibly in value. But fourth, a new cycle is overdue. The last time the market truly cycled, if you want to call it that, was the COVID crash. And like I said before, that lasted a mere 30 days and shut up from there. Guys, there are 3 guarantees in life. You've always heard death, you've always heard taxes. I had a third one, cycles. It is not possible for everything to be rosy at all times. And the same goes on the opposite side. When things feel like it's never getting better, we'll be the guy saying, valuations are great, you just got to be patient. So where exactly are we in the cycle? I don't know. Do I have a guess? Yes. What I said to you guys before is I feel that I've been saying it for a while that we're here. Maybe we're here. I just don't think we're here. I do not think we're here. And I look at that saying, okay, we don't have if you go look at history of stocks, we don't have the despondency. We don't have the people saying, F this, I'm out. Mm-hmm. We have that on the outlying shares of companies. Do you hear anybody talking about Nikola, Tattooed Chef anymore?
Nope.
Not at all. In fact, I get worried about the days when we have to wait. Our theory is, based on a friend of ours named Michael, he said when people have given up on Apple, that's when I will say, okay, we're getting close. Because Apple, Microsoft, Google, these are companies that generate a ton of cash, have great balance sheets. When people give up on those, that's going to be where I go, okay, we're close to the end, maybe. But even then, it can get crazier for a long period of time. Sooner or later, we've got to cycle out of these euphoric highs in the market. It's just a reality. Just like when things are bad, sooner or later, you have to cycle out of the despondency there. And let's face it, for a long time, we were spoiled. 0% interest rates, high-flying stocks, crypto coins. There were people making money hand over foot just from crypto and stock picking. These people made it seem like we were missing something. Like it's so easy to make money. Everyone can make a lot of money. Guys, go look at any good investor in history. When those things happen, it's very, very difficult for the future. But remember, if something sounds too good to be true or too easy, it probably is. And for every person who made a killing in crypto and EV stocks, there were tons of others who lost a lot of money. The Dogecoin millionaire is no longer a millionaire. And by the way, he created it as a joke. Your neighbor who bought Tesla stock at 300 is down big. Jeremy from Financial Education spent countless videos on Tattooed Chef, which is now worthless. He actually sold it like $1.50 with like some sort of 85% fall. And it's not an attack on him. We had a conversation where he claimed he's now into PayPal, which I kind of joke about, but I look at it going, we need to weed out all this crap. When you see guys like Tom Nash saying Peloton at 180 is a great buy, and now it's at $5 or $6 a share. Palantir, $45 a share, going to the moon. It ended up at $5. Now it's rebounded to 20, and we still think there's issues there. But again, maybe I'm wrong. Maybe the value investing community is wrong. Maybe we're in for more euphoric highs to come. That could very well be the case. If I'm wrong, I'm going to continue to buy the companies that make sense to me. And right now, there are 15 companies that I own that I would love to add more to. But that takes stocks falling further. I don't want stocks going higher, and I would love for you to want stocks to become cheaper. But then when you get your positions and they go up, you're happy either way. You're either buying a great company at a much better price, or your bet is working out. Either way, the world of a value investor is a happier world internally when it comes to your performance. Because again, you're either buying a company you love at a cheaper price, or your company that you've already bought is going up in price. So what do you think? Are you with me? Or do you think we're in the midst of a bull market? Do you think this is a new bull market? And if so, let me know in the comments. Keep it clean. Click the video above to continue to educate yourself on the economy and the possibility of a recession in the coming years. Thanks, and we'll see you on the next video.